So good afternoon and welcome to you all to today's online seminar organized by the Florence School of Banking and Finance together with Oliver Wyman Forum. The topic of today's discussion will be SMEs financing in the COVID-19 context. My name is Elena Carletti. I am a professor of finance at Bocconi University and I will be chairing the debate. I hope my connection will remain stable during the time. So I would like to start with thanking Oliver Wyman for joining us today in organizing this event, and welcome and thank all our speakers. Let me introduce them. The first that will give an introductory remark and set the stage is James Bryan. He's a partner at Oliver Wyman and is leading the EMEA Retail and SME Credit Platform. The second is Christian Ossig. He is the CEO of the German Banking Association and also chairman of the Executive Committee of the European Banking Federation. Then we have José María Roldán, who is the chairman and the CEO of the Spanish Banking Association. And last, in alphabetic order only, we have Frédéric Visnovsky, who is the National Credit Mediator at the Banque of France, and he is also the Deputy Secretary General of ACPR, which is the French Prudential Supervision and Resolution Authority. So thank you to all of you for joining us today. We really look forward to your discussion. So as I said, the debate will focus on the effects of the COVID-19 for SMEs. And here we mean liquidity needs, but also balance sheet development and eventually the need for strengthening them, and the role that banks are currently performing, may be supported by the government, in the SMEs financing. During the discussion, we will try and distinguish between the effects that we see in the short term and those that are more medium to long term. So how we organize the debate? As I said, Bryan will make a brief introduction to set the stage. Then each of the speakers will have 6 to 7 minutes, and I really ask you to please stick to the time for their initial remark on the situation in their respective countries. If we manage to keep the time, then you can have a second round also of responses so that you can comment on each other's initial intervention. Then we will open up the floor for the Q&A in the Q&A chat box, and I hope we can give at least 30 minutes to this phase. Please, as usual, try to ask brief questions because we are many connected, with a possibly indication of the person you would like to address the question, and possibly also a keyword so that I can try maybe and group various questions together. But what is most important is that you try to keep it short, although this is not always easy. So with that, let me stop here and let me give the floor to Bryan initially for his remarks. Thank you.
Thank you, Elena. Can you hear me okay? I think so, yeah. Perfect. So thank you for the introduction and the opportunity to speak today at this forum. So as part of my role of running our EMEA retail and SME credit practice, I've worked extensively across Europe and particularly in Ireland during the mortgage crisis, and then following that between sort of 2014 and 19 in Southern Europe, so in Greece and Cyprus, Spain and Portugal, on supporting banks deal with SMEs effectively in crisis. So just as some sort of introductory remarks, so what I'll do is just describe kind of what we see as the issues facing SMEs, and then how banks are reacting to that, and what are the future issues that they'll face. So, I mean, the impact on the SME world has been dramatic of COVID. So the initial impact was around looking to get advice on business continuity, HR related topics, basic questions during the lockdowns on how they can operate if at all. And then through the weeks, what we've seen is the impact clearly varies greatly across sectors. So there are some sectors, so airlines, restaurants, clothing, hotels, tourism, but have seen 80 to 100% of revenues decline through this period. There are other sectors that do well, so supermarkets, medical, software, games. They've seen positive revenues, maybe 10, 20, 20% through this period. And what's clear is that for the SMEs, liquidity is key. So our analysis with banks, and this is quite universal across many markets, is that the limit for most businesses is sort of 2 to 3 months of lockdown. So 2 to 3 months without significant cash flows before they run out of cash, which is why then the liquidity support that the governments are providing through the banking industry is so critical. So then what's been the impact on the banking sector? So I think what we see is that almost universally banks are very eager to be part of the solution here. They see it as a way they can have a really positive impact on society and improve their reputation across the markets. So clearly, they also had their own business continuity plans to put in place. But once that has been done, their main focus from a credit perspective has been on implementing the guarantee schemes and the various payment holidays or moratoria for individuals. So there's no doubt that the implementation of the guarantee scheme has been an operational challenge in many markets. So it's really brought into focus that for giving credit where you have a digital process or not across the banking industry, even if 10-30% of the loan is all that you're at risk of, with a high probability of default, that still means that for many banks they need to underwrite that loan. And then a general concern of the sort of level of indebtedness of the clients and how they're going about the affordability and viability assessments in that process. And then outside of lending, I think banks are keen to be part of providing an overall solution to clients. So things like digital applications and supporting with links for advice on employment issues, healthcare, etc., to really be a partner for SMEs during this period. So then moving on to what do we see as the future issues and looking forward. So I think for the SMEs, as hopefully the medical pandemic comes to an end, they need advice from governments about how they come out of lockdown procedures and how they will be eased. That will then kick into their own internal forecasts of what that means for their business and their sector, and will probably have to make their own cost adjustments in the medium term to address this, which will likely have an impact on employment. And I think we see that liquidity will continue to be a key concern, particularly if the lockdown scenarios moves to a sort of on-off scenario, which doesn't seem completely unlikely as we go into the autumn in Europe. From a bank's perspective, so ongoing dealing with the liquidity needs of clients, reassessing underwriting criteria, I think particularly for levels of indebtedness. So what would be a typical EBITDA to debt ratio before would need to be revised. And then a continued focus on how do we continue to improve our digital operations, both in terms of using fintechs for data collection, but also in terms of how do we continue to make these processes more and more easier for clients working remotely. And then what we've seen and what we've seen in other crises is that what will happen is that eventually things like the government guarantee schemes will end, the payment moratoria will end, and then the questions will come of how do we deal with clients who continue to face difficulties, which I'm no doubt there will be a population of SMEs that will face difficulties. So one will be about how to, once any payment moratoria end, how do you move a client back up to full payment? Historically, that's been challenging. Frameworks for dealing with clients in collections and restructuring. So how do you assess their affordability, viability, cooperation, and also determining is it a COVID-related incident or not? I think we'll see increased use of equity solutions versus debt restructuring issues, which may well come in at market levels. And then there'll be big questions about how these different options are treated from an accounting perspective, so from an IFRS 9 accounting perspective. And just to close, so clearly lots of future issues. I think our lessons from other crises, particularly in Greece, is that if you postpone these decisions about how to restructure clients and move them forward, which will be questions in sort of 3 to 6 months time, then you definitely create a cost for the future society, because not resolving those issues creates a lot of friction in the economy.
Thank you, Bryan. This was really setting up the stage of the discussion. I think also in particular your last point on somehow anticipating the restructuring and looking backward at, for example, the Greek case. I mean, I certainly agree with this. On the other hand, we also have the issue of not exacerbating procyclicality at the moment, and some regulations, in particular the FSR 9, of course, could induce to that. And we didn't have this regulation when there was the Greek crisis. Anyway, we have more time to discuss, I'm sure, going forward. So I didn't mention the order of the speakers, so let me do that now. So José María was telling us that yesterday that he has been locked down and at home for 50 days. So given this, we agreed happily to give the microphone to him to start. Then we go to Christian, so we have the German view, and finally we go to Frédéric, so that we get more, if you want, the supervisory perspective on the issue. So let me start with José María, please.
Thank you very much. It's a pleasure to be here with you in my first e-conference. That will not be for sure the last one, I'm afraid. That this is going to be more the new normal going forward. Well, I think that we have set the frame very easily. What is the situation that we face? Firms, because of the lockdown, the confinement measures, they are facing, hefty costs. They may have been able to control variable costs, but they have fixed costs, rental, etc. That no revenues, fixed costs. That means that you are going to have losses for these 2-3 months that you are going to be in a lockdown. Losses that can be very hefty. Let's not fool ourselves. So what we need to do is basically, there's no miracle solution. There's no silver bullet that will make these losses disappear overnight. We need to allow firms to distribute the impact of those, losses in these 2-3 months over the next 4 or 5 years. So we need to extend the finance to these firms so that they can absorb the problems going forward. And let me insist on this. This phrase is very hard to say when we talk about financial crisis, but really this time is different in the sense that differently to other occasions, we need to extend finance to avoid the collapse of the economy. So the traditional strategy for banks, to control risk and not to take too many risks in this environment because of adverse selection, or the instinct of supervisors, or looking very closely at what banks are doing in terms of risk assumption, will not work this time around. They may look rational from an individual bank perspective, but they are going to be extremely dangerous for the economy as a whole. I think that this has been very well understood by banks, by supervisors, by central banks, and by governments. The only way we can get out of this mess is, extending more finance, not trying to retrench and strengthen your balance sheet. Let me now go to the situation in Spain. Spain is a service sector economy, like most economies, a little bit different from Germany. If you allow me to put, the example of economy that is still very much industrial. We have a lot of relevance of the hospitality and tourism sectors. That's one of the characteristics and one of the fragilities that we have in our country. We have a prevalence of micro SMEs and self-employed workers. They are both fragile and agile. The fragile part, we know it very well from many studies, but let me concentrate on the agile part. The smaller you are, the more capable you are of inventing, reinventing yourself, transforming yourself. We have seen that, happening overnight. from producing shirts to producing masks, from delivering food to restaurant to delivering food for home, restaurants from giving food to clients to delivering them at home. So the smaller you are, the more flexible you are, and the greater the capacity that you have for survival. So this idea of fragile and agile, of micro SMEs and self-employed, is going to be a very important source of hope for the world going forward. The other element, general element I want to mention, is that in Spain, since 2012, since the global financial crisis, we have a movement of the leverage of the private sector, leverage of the public sector. Our debt to GDP ratio is a little bit less than 100%, but the private sector, the households, the self-employed in particular, and the SMEs have been deleveraging very strongly. In fact, the balance sheets, I have been in the chairman of the Spanish Banking Association for 6 years. I have been making the same forecast for 6 years, that by the end of the year, the balance sheet of Spanish banks, domestic business, will grow. This has not been the case. For 6 years in a row, there has been a reduction of credit extension to the private sector. That was a problem in the sense that was squeezing profitability and margins. Now it's an advantage that the private sector in Spain is not over leveraged. And let me turn now to what we are doing in practice to help the economy. We have a government-sponsored program through our official credit institute, ECO. We are talking about a program that is, size is 100 billion euros, 8% of Spanish GDP, risk-sharing between, the government and the banks is 80-20. 80% of the risk is going to be on the hands of the government, 20% on the hands of the bank. It's pari passu, so we share the losses. But this 20%, and it's an important element, is strong enough. This risk retention is strong enough to ensure that only solvent clients will get the loans. Up to now, of these 100 billions, 40 billions have been rolled out. Figures of last week were that we have 25 billion euros of first finance reaching SMEs. We are talking about close to 200,000 firms, self-employed, that are receiving this type of financing. We are talking about mostly of SMEs, 14 billions, with an average of 76,000 euros. So we are talking really about, financing needs that are not, skyrocketing at the individual level, but that are very relevant for firms to be able to continue activity. Just to be finalizing and not to make these introductory remarks, very long, what are the problems, the limits that we are seeing? There is a little bit of panicking on the size that has been rolled out, although we have 25 billion. The fact that the extension is tranche by tranche is creating a little bit of, I wouldn't say panic, maybe it's too strong, but a little bit of anxiety on the side of firms that have not yet, been delivered this finance, that they will be left outside in case that, the program does not continue increasing over time. I think it would be good on the side of government to increase the size of the program to this 100 billion to make sure that firms do not face this type of panic, and at least that uncertainty is gone. The other element is that not all firms will get finance. I was telling you that this 20% risk retention is strong enough to ensure that banks will only, extend finance to solvent clients. That means, whether we like it or not, that not all firms will get finance. Not all will make it. Some firms that are too weak in their financial structure, or too weak because they have just started very recently, or too weak because they are in sectors that have been hit very hard, will not be able to make it. So we are in the business of giving loans. We are not in the business of delivering grants or subsidies or equity. That's not our business. And I think that, there's some confusion, maybe not unintended, but some confusion of approaching this as a subsidy. This is not a subsidy. This is a financial program. The liquidity is coming from the bank. Banks retain this 20%. So this is something that worries me going forward. That maybe for some sectors, for some companies, you need to have other type of instruments, grants, subsidies, equity. I know that, Elena, you are proposing something there that looks very interesting. I was reading the paper yesterday, looks very interesting, it's kind of, turning Europe in a business angel in these uncertain times. That's a good idea. But banks are not in this business. Banks are in the business of delivering finance that has to be returned by solvent clients. And with this, I will stop for the debate. Thank you.
Thank you. Thank you very much, José María. I think you raised many interesting points. One of them is that, of course, even if you are giving, first of all, you are giving the lending now only to firms that, at least before the crisis, were solvent. So this means that we are deliberately and possibly rightly so, letting many firms going out of business. And the question is, going back to James, how do we deal with this for banks? Because many of these will probably have bank lending at the moment. And second, of course, there will be also going forward, not all those that are solvent pre-COVID will remain solvent post-COVID. So here maybe for banks will only be 20%. But nevertheless, the assessment of which firms will survive is at the moment very complicated. You also said no subsidies. So now let's ask Christian, how does he see the situation in Germany, where maybe subsidies are part, at least in small part, of the idea of the package. So please, Christian.
Thank you very much, Elena. Good afternoon to everybody. To avoid confusion, I'm not in Berlin today. I'm in my Frankfurt office, so that's not the Berlin skyline, but the Frankfurt skyline that probably most of you can recognize easily. Elena, in the preparatory call, she asked me to talk about three things in my opening remarks: about the situation of SMEs in Germany, about the state measures to help SMEs, and what are the challenges banks are facing. And I'm going to start with the first one, the economic situation and the challenges for SMEs. Economic growth in Germany this year is expected, or we expect economic growth to decline by over 6%, and relative to the growth that we forecasted, it's down 8%, and it needs a lot of imagination to imagine how that could be caught up next year in 2021. What does it mean for public debt here in Germany? Public debt was around 60% debt to GDP ratio. The crisis is we expect public debt levels to increase to 70 or even over 80% by the end of 2021. And that depends on the length of the shutdown and the depth of the shutdown. Turning to SMEs. First of all, what do we mean by SMEs here in Germany? These are typically family-owned companies, and their financing relies entirely on bank funding if it's not their own equity. And what by German standard is an SME is up to 500 million euro turnover. I know that in some other countries these are rather sizable enterprises. I give you some numbers on the SMEs. 58% of all Mittelstand companies have faced losses in March this year. And these losses are about over 50% in sales on average. So over 50% have lost over 50% of their sales in March alone. That is about 80 billion euros sales in March, 2% of their annual turnover. And we're talking about only 2 weeks shutdown in March. Huge numbers. What's interesting, James said liquidity should last for 2 or 3 months. The data we have is that 50% of the Mittelstand here has liquidity for less than 2 months in a shutdown situation. So 50% of SMEs have liquidity at best until the end of May. And now these companies get liquidity support. They have a profit turnover ratio of 7.4% on average, which tells you a lot about their ability to repay debt at a later stage. So 70.4% profit over the turnover. Equity ratios here in Germany are high of the SME sector. We have 30% equity ratios, which means liquidity is now the most urgent need. But if you calculate your scenarios further down the road, there are also equity shortages ahead. So much about SMEs. Let's quickly look at the state programs. The state in theory, and explain what I mean by in theory later, could mobilize 1,900 billion here. That has been the money that is being made available in theory by the legislative changes and other measures brought underway. That is unprecedented. That is 25. This is 50% of German GDP, and that compares to, I believe, something like 25% for France, or a little over 10% in Spain. These measures are essentially guarantees or loans or equities. So big numbers. I will explain in a minute why actually only a fraction of that is really operational. To put that into perspective, the state measures are not only lending and liquidity support. There are a lot of tax-related liquidity assistance that was granted. In Germany, there is a short-time working tool that gives a lot of support to the SME sector. If I look at sort of the funding measures, there is a grant subsidy program in place for companies that have up to 10 employees. And that is, depending on the number of employees, either 9,000 euro or 15,000 euro, 1.5. And that does not have to be repaid. In total, I believe that is something like 50 billion euros that have been made available there. The bigger bulk goes via KfW. The grants are not being channeled via KfW. That is the lender who do that. KfW has started and expanded existing and started new liquidity assistance programs. Officially, they are unlimited in volume. In fact, it looks though that this should be something in the range of 115 billion euros channeled through these KfW programs. The risk retention here depends on the program. For the banks is between 20, 10, or even 0% risk retention for the banks. The 0% risk retention, of course, is only for SME lending. That is a new fast-track loan process up to 800,000 euros for SMEs up to 250 employees. The biggest number of support in terms of total assets here, the bulk of aid, should come through an economic stabilization fund. And here we talk about 500 billion euros that in theory have been made available. Of these 500 billion, 100 billion should be an equity tool, and 400 billion should be available for guarantees. Now, a lot of focus was on that economic stabilization fund in the early days of the crisis. A law has been introduced over the weekend, and many of us who have been working on that law, this fund is still not operational, and it doesn't look that it's going to be operational very near term. So what I'm saying here, on paper it looks like huge numbers, 50% of GDP. If I really look what is operational here, it is much less. The hurdles for SMEs and companies to benefit of these state programs are high. From a bank's perspective, I would say they are too high. The hurdles include a dividend ban for corporates, they include restrictions on compensation for management, etc. All very good reasons for corporates actually not to use the means that have been made available. And that is something that we see very critical, because it would be a very important line of defense to really put this money at work that is available in theory. Let me conclude quickly by looking at the emerging challenges for banks. It has to be said very clearly here, and I know that José María is going to share that view. Banks are here totally on the side of our clients. Everybody in the banks works extremely hard under very difficult conditions. The financial sector today is part of the solution. It's not like in the last crisis where we were more associated with the roots of the problems. Banks can deliver that role because they are in a much better position than they were 12 years ago, both in terms of equity, both in terms of liquidity endowment, as well as both in terms of asset quality. And that is not only the case in Germany, I would say that's the case throughout Europe. Now, where are the challenges banks are facing? First of all, it's the sheer number of corporates that are in need of liquidity support. So there is really an amazing volume of applications hitting the desk of our banks. And even if we draw on state support measures, we're talking about a lending process, right? There are credit standards that need to be taken into account, even if risk retention is small. And that makes it really complex, and there is a huge workload right now on the desk of many banks here. The lending volume has increased substantially of banks, and I'm saying that it's only a smaller part of liquidity support that draws its funding from KfW and state support measures. The much larger part comes from the liquidity that banks have on their books. In the case of many German banks, we're talking about historically a lot of excess liquidity that banks in the past had to park with the ECB and had to pay 50 basis points on the liquidity parked there. Now banks' priority is to put this liquidity that they had on their balance sheet at work. And when we say there is a lot of liquidity provision, the ECB this morning published 5% lending to corporate increase March 2020 versus March 29. Most of that is coming from excess liquidity banks had on their books anyway. The KfW programs are a smaller part of that. We have seen until April 20, there have been 30,000 requests for KfW loans, of which we banks, we have to administer these requests. We managed to present to KfW 14,000 applications, and 3.5 billion of KfW loans were paid out until by April 20th. Final thoughts on talking about banks. One really has to applaud supervisors, regulators here, not only on national level, but also on European level. And it's clear that as a banking representative, I'm not doing that every day, but we really have to recognize that supervisors, regulators have done really an outstanding job. Very early on, Andrea and María and the SSM, they have put the capital buffers at work and have made them available. A lot of procyclicality. Elena, you mentioned IFRS 9, definition of default is another element here. A lot of the procyclicality has been taken out of the system to the extent possible. And yesterday we have seen Visnovsky's presenting the legislative changes that should be made to CRR. So policymakers, supervisors, regulators have really done an enormous amount of really smart measures to enable banks to be on the client side these days. What is surprising, what is missing from my point of view, I was very surprised that supervisors, in this case the Single Resolution Board, has not touched the banking levy. Banks today are receiving invoices to pay 9 billion into a Single Resolution Fund. The Single Resolution Fund, in my point of view, had the room for maneuver to postpone the 2020 payment there, and that would have enabled the European banking industry to hand out 200 billion additional credit to clients. So rather than having 200 billion to put to work for clients, we are paying 9 billion into a Single Resolution Fund. We could have easily paid these 9 billion a year later. Other SME specific to-dos on my list, there are open questions in relation how the state support loans, whether they should count towards leverage ratio. Same question is, do these state support loans count towards the banking levy? At the moment, both is the case, and both should be addressed in order to encourage banks to use these state support measures. If it counts, if it counts towards leverage ratio, or if it increases your banking levy burden, that discourages banks to use these loans. And the last thought I want to finish with Basel. We know that the last round of the Basel implementation is still pending, and we also know that Basel, the way it's on the table right now, is going to hurt substantially SME lending, because especially unrated companies are going to find it harder to access credit if Basel were to be implemented in that way. So Elena rightly so said, let's focus about short-term measures. If we talk about more long-term measures, we need to address the Basel Agreement the way it is on the desk of the Commission right now, because this is totally counterproductive. If we would have that Basel Agreement in place right now, credit provision to SMEs in the current situation would be much more difficult, and banks would not be in a position to deliver what they are delivering right now. I would stop here. Thank you.
Thank you very much. Thank you very much, Christian. You give the floor to Frédéric, given that your last part was about regulation and the role of supervision. And let me just pick up on one point. I mean, you made many interesting points, but one of them I think is worth thinking also more in the discussion, which is sort of the conditions under which state guarantees or guaranteed or state loans are provided to firms, and therefore the incentive for firms to take up these loans. Because otherwise it's a missed opportunity on the one end, because we are not using the bazooka or at least the public funds that we have available. But on the other hand, this also increases the risk for banks, because this means that banks may have to be drawing the credit lines rather than being able to use themselves these guaranteed programs. So with this, let me give the floor to Frédéric.
Yes, thank you, Elena, and good afternoon, everyone. Three things. First, a short word on what is credit mediation, because I think it's a specific organization in France. Second point, what kind of measure we have taken in France, and third, what are, from my point of view, the main post-crisis challenges. So first point, what is credit mediation? Credit mediation is something we have created in 2008 when with the banking problem, then we want to be sure that banks will be able to continue to provide credit to corporate. So the credit mediation is something which is organized by Banque de France in our 100 branches, and the objective is to help companies experiencing difficulties with banks, so to analyze their situation and to dialogue with the bank to find a solution. So it's a mediation. There is no obligation, of course, at the end for the banks to provide credit, but in practice we have a success of mediation around 70%. So of course in this crisis it is also a tool which will be used. So that's the first point. Second point, what has been done in France, we are in the same situation in which there is a decrease in the activities in some sectors, around 50%, in some sectors more than that, 80 and 90 or 100% if we take the restaurant, for example. So the main objective, of course, of the measure is to provide the cash for this corporate. So three main measures have been taken. First one, by the government to reduce expenses, so to provide partial unemployment, reduction of fiscal and social charge. So it's around 100 billion, so 5% of gross domestic product, so it will increase by 5% the state indebtedness. The second measure is that banks agreed to provide a 6-month moratorium for all loans. And the third measure is loans provided by banks with a state guarantee. The guarantee is up to 300 billion. This was calibrated compared to 240 billion of short-term loans by end of February. So it's the way we calibrate this type of measure. The main feature of this guarantee, first of all, it covers at least a maximum of 25% of the turnover of the corporate. There is a 1-year moratorium, but after 1 year there is the possibility for the corporate to convert the loan up to between 1 and 5 years. So it might be from the beginning a 6-year loan with the guarantee. And of course there is an increase in the cost of the guarantee during these years. So the guarantee covers the loan with a different ranging from 70% to 80%, 70 for small, 90 for small entities, and 70 for the bigger one. So there is a residual risk for the banks. The objective, of course, is to be sure that, and I think it's the same in Spain, that banks are delivered to corporates which are able to reimburse the loan. It's not a subsidiary, it's a credit given by banks cover between 70 and 90% by the state, but there is a residual risk for the bank. So as I said, the cost of the guarantee also depend on the size of the institution. It's for small one, it's 25 basis points. And there is no interest for banks, so they provide credits only taking into account their refinancing cost. There is no margin. The result for the time being, so we deliver more than 40 billion euros for 280,000 corporates. More than half of these are going to very small entities, less than 10 employees, 1/3 for SMEs, and the last part for medium institutions. And for large corporate, it's an ad hoc agreement with the minister. So only these 40 billion, it's only for SMEs and very small entities. Large corporate are following a different way to deliver the guarantee. So that's the measure we have taken in France. What are, from my point of view, the main challenge? First of all, I think there are two main challenge. General one. The first one will be to organize the post-crisis, to make sure that all these institutions which have been locked out for a long period of time are able to recover. So what banks could be in this field. The second point, of course, general point, will be how to deal with an increase in indebtedness at state level, because as I mentioned, there is a direct cost, which are these 5 fiscal measures, so 5% of gross national product, but the guarantee might have a cost also. We will see at the end. And then there are three topics from my point of view, which are also very important. It's a debt. It has to be reimbursed. So we are in a situation in which we are increasing the debt for SMEs, and debt is not always a solution. That's why we already try in our measure to provide also capital. If banks are not willing, and after mediation are not willing to provide credit to some institution, it's of course important to find solution for some of them. So there is we have also put in place loan with 100% guarantee by state, and part of this we will account as capital, which is important from our point of view, because it's important right now to try to increase the solvency of these SMEs. That's why also the second measure which has been taken is to create a specific funds with funds provided by insurers, which will provide also capital to SMEs. So that's the first point. The second point, of course, is that's what we are doing at the national level. From my point of view, there is also a question at European level. If we want the banking union being a reality, it's the opportunity, I must say, with this crisis. It's always the same. We should take advantage of a crisis to go further in the banking union. So from this point of view, I think there is probably something to do at the European level with equity funds or anything to increase and the solvency of SMEs in Europe, because the situation in France is the same in other countries, and we really need this type of instrument if we want to get better after this crisis. And the last point, last challenge is NPL in the banking system. Even if we have a system of guarantee and a different situation in different countries, but at the end, and the guarantee covers new loans. So we have to take into account what will happen on the stock. So there will be certainly an increase in NPL. So we have a lot of discussion, still discussion in the past on bad banks at the European level, and I think it's the opportunity again to think about this and to try to not to be in a situation in which we will keep the consequences of this crisis for 10 more years and going to a new crisis in 10 years without solving the difficult situation in which our SMEs and other corporates will be. So I will stop there and open the discussion. Thank you.
Okay, thank you, Frédéric. Thank you very much. This is somehow makes me, in a way, make two comments. The first one is I'm struck by the diversity of programs in the different countries. And maybe Christian may say, well, but the whole amount, the whole pot in Germany is not yet operational. But of course, you can imagine that the fear of, in particular, as being Italian, let me allow to say that, the fear of the weaker country is that, of course, this will affect the level playing field of the company going forward, of the economies in general, because, of course, if each country can put up a different program with different capacity, which leads me to Frédéric's point of, do we need something more at the European level? Be in capital, be liquidity, but do we need somehow an instrument that can bring again a little bit of level playing field across Europe? Second point, and then I'm going to each of you the microphone to make very short remarks before opening up. Second point, Christian in particular mentioned the fact that the supervisors and the regulators have relaxed regulation substantially, and rightly so, you were applauding them. Now, the question to me, a little bit in line with what you were saying before for companies, also for banks, unless the supervisor forces banks to exploit this flexibility, it's not clear that banks will really make use of it. Because as for firms, there is a stigma for banks. So how do we do this? Because if we don't go beyond the stigma, in a way, the relaxation that is provided by supervisors and regulators will not be fully exploited. And then it is a little bit like your bazooka in Germany. We have a big sum there, but it's not operationally workable. So how can we do it? Shall we force the supervisor to somehow force banks to take up this flexibility, but maybe they don't have the legal basis even for doing it? So how do you see this problem in the banking sector? So maybe we can now go, if you want, in a different order. Maybe we go Christian, Frédéric, and then José María, and then also James, if you want to add something. But please brief it so that...
I'm going to be really brief because I noticed I was very long before. I understand that from a European perspective, to see Germany on paper 50% of GDP, Spain 10% of GDP in terms of state support measures, that looks very unbalanced. It's we are here, we have people from the European University Institute on the phone. That's an exciting research question. All I can tell you from Germany, of these huge numbers, a bulk of that is not operational at all. That's point one. And B, the hurdles to use the money that is being theoretically put at work here are very high. And companies, you saw Lufthansa yesterday, that they renounced to take up liquidity support, unlike Air France, because hurdles are very high. That would be my first point. Second point, does it mean we need European measures? We definitely need to have a discussion on European measures. I have no good answer what they could best be. I liked what in our pre-discussion yesterday, and you apologize, José María, that I'm repeating what you told me yesterday. And José María yesterday said probably the biggest focus for European measures is on the restructuring phase. I would like to subscribe to that. But we need a discussion on what could be done now beyond what is already brought underway on European level last week. Interesting is this discussion on bad banks. My gut reaction to that would be a bad bank that deals with NPLs that were accumulated before Corona on European level. I don't think that would send the right signal. A bad bank to deal with corona-related NPLs, that is definitely worth having a discussion, but it would be much too early right now, because at the moment we do not see NPLs in relation to corona. That is something that we need to look at a later stage. And then, very interesting point you made, Elena, stigmatization. Yes, take the example of leverage ratio, liquidity coverage ratio. Andrea Enria now gives banks room for maneuver to not stick to liquidity coverage ratio. All banks I speak to, no one is going to do that, because it would be associated with a sort of stigmatization. And yes, there is work to be done in order to enable banks really use the additional flexibility they have gained. To some extent, the CRR changes that are being brought underway yesterday, they deliver that. But there is definitely more to be needed, more work to be done in order to avoid the stigmatization that banks have and fear if they use some of the room for maneuver that supervisors have given them now.
Thank you. Frédéric?
Yes, thank you. Well, on the diversity of program at the European level, I think from my point of view, it's not the main issue. Of course, Europe is not organized for the time being to provide as soon as we need this liquidity support, this cash to SMEs. So this has to be done at the national level. It's not an issue for me. The main issue for me, as I mentioned, is to be able at the European level to build something post-crisis. And I agree when I'm speaking about bad banks and NPL, I fully agree that it has to be taken into account only the corona impact and not the past. We have to take into account the fact that this crisis is very specific. It's not due to any problem in banks, it's not due to any problem in SMEs, it's due to the fact that they have to stop their activity. So we need to have, if we want to see Europe as a reality, it's really the opportunity to build European approach, industrial approach, and to have this type of bad banks, equity funds. I don't know, there are a lot of tools which are needed if we want to go out of this crisis, which will have a consequence for many years. It's not only a liquidity problem for some months, it will have consequences for many years. On banks, well, from my point of view, the main objective is to, and that's all the buffers have been put in place for this type of situation, in order for banks to be able to continue to provide credit to corporates. So what has been done by supervisors, from my point of view, is legitimate, and for the time being, I don't see any stigma. Of course, the situation might be different when we will see NPL in different banks, different countries. We will see. It's very difficult for the time being to know exactly. So at that time, of course, we can be in a situation in which this crisis, which is not a banking crisis, might be in the coming months, years, I don't know, also a banking crisis, which will be a huge issue we need to take into account. That's why also the Basel Committee has decided to defer the implementation of Basel III, and the finalization of Basel III. So supervisors need to follow what will happen in the coming month on the banking result, and then to take appropriate decision in the field. But from my point of view, it's not for the time being a question of stigma. Thank you.
Okay, so we are almost at 2 p.m. and we would like to have a Q&A. So let me suggest the following, that José María has 2 minutes, and then maybe James picks up, in the Q&A part. Okay, José María.
So Very fast. Let's try to make it in 1 minute. This idea, that we are given, regulatory holidays to banks, and they should be grateful, and we are going to be careful looking whether they abuse it or not. Sorry if I'm strong. This is bullshit. First, in the regulation that was designed, this idea of countercyclicality was very well in the rules. So what we are doing is applying the rules of being countercyclical, being tough on the banks in the good times, and be a little bit less tough with the banks in this situation. First. Second, these morality lessons that I'm starting to see on the political side, it really makes me mad. This has not been a problem of the banks. This has been not a problem of the SMEs. We are confronted with a situation that is not making a difference between good and bad bank managers and good and bad firms. It's a tsunami that we are facing. So be careful with what you say to banks, because right now banks are doing what they need to do, to be with the clients, to extend credit in very difficult situations, and we have to be careful to respect, this space, because if we start to get these morality lessons, well, I can see that some banks may say, well, okay, guys, I'm going to fortify my balance sheet and wait for this tsunami to pass, and let's see who survives. This is not what we need to do. We need to go together, banks, clients, regulators, central banks, and governments, sharing responsibility, but also, sharing the messages.
Okay. So maybe, so first of all, there is a request, and sorry for this operational comment, if we can lower the volume of the speakers a little bit. It seems that it's a bit high. Then while we're waiting for more questions, because it takes a little bit of time, maybe James, if you want to add just a comment, and then we go for the Q&A.
No, I was just going to, so the only thing I would add is I think the idea of the structural solutions of the bad bank for NPLs for clients who suffered through COVID, I think is something that definitely needs to be looked at further. I think the one thing I would say is that from our experience, you realize that actually a lot of the problems that exist in terms of working through SME in SMEs in distress exists at a local level, with rules around which collaterals can you repossess, what's the insolvency process for SMEs, what documents are required to push that forward, how you involve third parties, so notaries, accountants, etc. So whilst at a European level actions can be taken, there's often a lot of issues that exist at a country specific issue that cause problems. And then the other thing I would say is that I think within the banks, I think there is a tooling requirement of how do we assess these SMEs, which solutions do we need to apply to them, and the EBA guidance on dealing with NPEs is relatively specific on the types of tools that are required. I would suggest that there's probably an upgrade of some of the bank's capabilities required to get to some of the levels that are seen in those guidelines.
Okay, thank you. So let me now open some of the questions. So first, there is a question by Patrick O'Honohan that actually, thanks for joining us today, Patrick. How do the speakers see the role of the IAB's new measures in contributing to the SME financing issues on a pan-European basis? Is this sufficient? So this is the first question. The second question that I find quite interesting is the following by, by Bode V. Berger, sorry if I pronounce the name not correctly. He asked, even if banks would actively steer down capital to provide more credit, so assuming that they do it, so there is no stigma that they care of the measures, the relaxation, at some point, this capital should be restored over time, because anyway, this is just a temporary measure. And in most cases, there is no indication of how this temporary measure is going to last. And maybe Okay, maybe just take two questions. Maybe Frédéric first for the temporary measures and the need to restore capital.
Thank you. Well, the European banks, of course, it's something which is important. It will that's the first step, as I mentioned, to have a European response. I'm not sure it will be sufficient. I think that the amount of funds which will be needed post-crisis are much higher compared to what is already possible for the European Bank. But that's one step. And I fully agree on the second question. It's temporary measure. It's a credit. It has to be reimbursed. In France, as I mentioned, it has to be reimbursed after 1 year with the possibility for the SME to request to have a loan between 1 and 5 years. So it might be from the beginning a 6 year, but it has to be reimbursed at the end. That's why the measure which has been we need to add is measure to reinforce capital. If I take the situation in France, 90% of the corporate are small corporates, less than 10 employees. 20% of these has insufficient capital already before the crisis. So that's why we need post-crisis measure to reinforce the financial situation of this corporate which has been affected by the crisis. This should be the response after crisis, if possible, of course, during the crisis. That's what we are doing in France for some part of them, but it won't be sufficient. We need to do more with European funds and so on.
Okay, let me ask another question. Maybe we don't ask all questions to everybody. Maybe to Christian. This is a question by Marcel Magnus at the European Parliament. So what is the panelist's view on generally restricting AT1 payment to preserve capital ratios without the stigma that would come with that if done individually? So this is for Christian, and then maybe one, well, let go this Christian, and then I look for one for José María.
This question on AT1, and I hope that the sound is now better. I've put the volume down. I hope that you can still hear me, and I hopefully don't bother you anymore with being too loud. The AT1 question can be combined also with the question of dividend payments. And that also has a lot to do with the question that Frédéric just answered. What is the bank's ability to rebuild equity base, depending on how this whole situation is going to work out, and might erode some of the equity in long term of the European banking sector here. And that is a very, very tricky and difficult question. Many supervisors in the last year, they have started to look at banks' profitability because they have understood that part of what makes a stable institution is a high or a decent level of profitability in order to pay a return to investors, regardless whether it is an ordinary share or an AT1. I think what we really need to keep in mind here is if we want to strengthen banks' equity base, also in a post-corona world, we need to be very careful here to the extent we intervene either on dividends or pay interest on AT1 instruments. I understand why people kind of draw the comparison. How can that be that we now put equity buffers available at banks and then they pay a dividend or they pay interest on AT1? But we need to take a long-term perspective here. And for banks to pay a return on different types of equities is crucial for the future as well. It's a very difficult signal that the supervisors are sending if they ban dividend payments or interest payments on AT1. My reaction was on dividends. It can be justified in the current situation not to be able to pay an interest on an AT1 instrument. I would not be a fan of that idea in this current situation.
Indeed, this is. I also agree. This is a very difficult question. Let me ask one which is maybe a little bit different to José María, and this comes from Valerio Giovannini from UEFA. So given we know how much Spain is into sport and football, So football sports associations can be considered SMEs according to the definition given by the EU Commission. Having said this, would you suggest a specific instrument to sports associations that have problems of liquidity? No liquidity means also to put in danger thousands of jobs all over Europe. This is a discussion that we also have in this country, in particular with the reopening, the legal.
Well, my view is that
María,
the role that we need to play here is try to preserve as many firms and jobs as possible. So the job intensity of a firm is an element that should be, considered when devising government measures in terms of liquidity support. Second, well, we are going to be not just talking about sports, but about everything that we do. We are going to go into a new world. When I look at what was my agenda, in the last 6 years as chairman of the Spanish Banking Association, almost everything I did, I will not be able to do it in the coming year. So this is not that my job has disappeared. It's simply that we need to reinvent the way we deliver our services to our members. In the same vein, football, I'm sure that broadcasting rights in many countries, in Spain for sure, are far more important than revenues from, physical assistance to the matches. So we will have to find a new normal, all of us, and I think that's the challenge in the new normal. What I'm going to do to deliver my services, to deliver my production. How do I need to change my approach? Applies to football and applies to everything. But frankly speaking, right now, the salary of some of the football players around is not something that worries me. What worries me is all these people that were working in the hospitality sector in Spain, with relatively low salaries, to be sure that we can find an alternative for them. And I'm sure that we will be able to find that way forward, all of us individually and as countries. So I'm an optimist in there, also on football.
Thank you very much. So I think we can just have one short round of questions and then we have to close. So one to Frédéric concerns what you said before about banks' margin. You said before that on loans with the state guarantees, banks are not having any margin. So the question is, how can you incentivize banks to provide?
Well, it's a good question. It's a major crisis, so everyone has to support a cost in this crisis. There is a cost which is supported by state, and there is a cost which is supported by banks with no margin, but it is their client. So the interest of banks is, of course, to see their client to survive this crisis. If they default, for the future, their client will disappear. So the incentive is only to be sure that their client will pass this crisis. That's why they provide with any difficulties, and we follow, of course, the market share of this guarantee by state, and all major banks are providing credit to their clients. So, and they accept, of course, the fact that there will be no margin on this product, but there will be margin in the future, in the recovery, and so on.
Thank you, Christian. And to the bank representatives, how can banks execute proper due diligence under time and resource constraints with the COVID-19 bridge loans and prevent fraud and abuse? I think this goes a little bit back to your comments before that indeed the banks are overloaded with the requests. So how can they do it? And then let me just ask one for José María, so then we maybe close. The question is, how can we make sure that the spread to SMEs in different countries doesn't widen asymmetrically? In other words, how can we make sure that we are not back to 2009 or 11 and 13, where similar firms had a very different spread just because of this?
You had politicians in this country that said, all banks should be 5 Grade sein lassen, meaning banks should not be so diligent here. And to be very clear, it's a credit process, and that puts, indeed, that is a huge challenge for banks right now, because they need to adhere to the same standards as they do under normal circumstances. And when I said at the beginning, banks are working extremely hard, that is exactly what I meant. And it's not only in relation to credit standards. If you just think of the AML challenges banks are facing right now, what really pays off here is if you have a house bank relationship, and if your bank knows you, and that helps a lot in the current situation. I would like, if I may, Elena, just say one sentence on what I saw on the poll question. Is this for banks more an opportunity or more a liability? I can tell you, maybe it's a very German perspective, it is much more of an opportunity than a liability. It is a huge challenge. But banks here have a lot of excess liquidity that in the past they had to park the ECB for minus 50 basis points. To put that money now at work at clients, and maybe also under a normalized margin world, is an opportunity. And that is why banks they're not only working hard because they are altruistic and they want to help the economy, they're also working hard because it is an opportunity for banks. And I thought it said only 33% think it is an opportunity. I think from my perspective, it's much more of an opportunity than a liability, which does not mean that it's a huge challenge.
On the second question, and I go, Elena, directly to answer that I was asked, what are the solutions? First, understand that in order to ensure that firms have the same, let's say, rights in terms of cost of financing related to their risk, is completing banking union and completing capital markets union. I think that Frédéric was pointing out to this as a fundamental element. I think that going forward, we need to understand that the only way we can guarantee that firms have a level playing field is completing banking union and capital markets union. Second, when you're talking about SME, level playing field means level playing field for all European banks. Because, I also some questions on whether, dependence of banks was a liability for SMEs. Well, I cannot see, this shadow banking sector that has been so lightly regulated. I don't see any of them, now volunteering to finance SMEs. SMEs are going to be financed by banks and probably locally. So even though you can have European instruments, and I'm not denying that possibility, I think that, being very carefully strengthening the banks and, ensuring a level playing field among European banks, completing banking union, completing capital markets union, and not being naive that when things go rough, the only ones that are, financing the European economy are European banks.
Thank you. I was actually also very surprised to see this poll. So let me finish with James. We haven't given the microphone much in this Q&A. With the poll question number 3 that was asking, what is the most effective way for governments to support SMEs in the COVID-19 times? Guarantees, direct capitalization, deferring tax obligation. And the polls were 45, 30, 25, respectively. So what's your view on this? And also, there were, if I may, some other question on whether we need to rethink the financing to SMEs more generally.
No, that's right. And as you can see from the results, it's quite a diverse range of opinions. So I think during this crisis, the guarantees have been the easiest way of providing that finance. I think as we and also actually many governments have deferred tax obligations as well. So I think both of those have been pretty effective. I think what we'll see is that as time passes through, I think particularly for smaller SMEs, then a desire for equity-like solutions, so direct capitalization or provision of equity, I think will become more effective, because I think the burden of debt on many of these companies will become too much, and so the only way through that is to change their equity and capital structure. And then I was just going to comment on a question about someone asked about the kind of how do we see lending changing for SMEs in the next 2 years. I think that there will need to be changes to the underwriting criteria. So as I say, I think people's definition of a highly leveraged company may need to change during that period. I think you'll see more sector specific come into the lending criteria. And as I say, I think you will see an acceleration of the trend to digital. So a need to get more up-to-date data on clients. So I think one thing banks have really struggled with during this crisis is having up-to-date data on the status of their SMEs. plus putting in place a way of clients applying digitally without so much paperwork, which exists in many countries in Southern Europe. I think you'll see those two trends, which have already started. I think you'll see them accelerate over the next 2 years.
Thank you, James. So let me, with this intervention, conclude the webinar. Thank you to all of you. This was the most interesting discussion. As you also may have read in the Q&A, many participants congratulated you for your remarks. So thanks again, and I hope we will have you again at the Florence School of Banking and Finance. And goodbye to everybody, and thanks also to the participants.